Good evening, everyone. I'm going to take on a very small topic in the next 45 minutes, the efficient markets hypothesis. And the reason I wanted to take it on in this lecture series is that I got a feeling after the financial crisis burst or erupted or arrived on our consciousness, a lot of people started a fight that some of them had started 25 years earlier. It was one of those fights that you thought everyone had forgotten about when you woke up on Sunday after your hangover and you thought there was a fight in the pub. I don't exactly know what happened. And you'd have forgotten about it for several years. And then when the two individuals met each other again, the fight started again. And I think the fight that erupted at this time was an intellectual fight rather than a physical one. I don't think I'm used to physical ones either, but I think it was an intellectual fight. It was between the kinds of people who've been dominant, I think, intellectually in the last quarter of a century, the previous quarter of a century, and those people essentially evolved around the idea of rational expectations and the efficient markets hypothesis, both of which we'll think about a little bit in this lecture. And actually there was a current at the same time that these sets of people were becoming quite dominant intellectually at universities, in policy-making fora, in central banks and in governments. There was another bunch of people thinking very hard and talking about informational asymmetries, the very idea that it was maybe costly to get information, that rational expectations may or may not be in place. You don't need to move away from rational expectations just to have informational asymmetries matter. But they may want to go even further and argue that the idea of rational expectations, and let me be clear about what rational expectations are, this basic idea that we're smart enough or we can learn from others so that our subjective priors of all the possibilities of different states of nature and the returns from those states of nature are essentially the same as the objective or true probabilities of those states of natures and the payoffs from those states of natures. Now, you can throw in all kinds of stories about learning that's subjective over time. You make mistakes and you learn converges on the objective, which is the true. Or you can say innately, because you've been coming to Gresham lectures, that you immediately know the objective, posterior distribution, you don't need to learn very much. But whatever you say, you may want to say that I don't believe in all that gumph. I think people are, and I'm not saying I think this for a second, there's a bunch of arguments out there that people are either dumb or they make mistakes or it's very costly to change their opinions. And as a result, expectations evolve in a sticky manner rather than in something that's more forward-looking and what we might call rational. And the moment the financial crisis erupted, I tend to date it myself from August 2007, but a lot of people date it from the collapse of Lehman's in September 2008. I see them as part of the same process, I guess. In a way, we certainly learnt that something was wrong in August 2007. And the most obvious manifestation came a year and a bit later with the collapse of Lehman's. And that, I think, opened the fight again. It was a case of someone having dropped the beer or whatever it was and saying, I told you this was wrong. I told you this path on which we travelled, which involves financial deregulation and liberalisation, was one that would lead to problems. I told you, said the people who believed that markets were full of asymmetries, frictions, and that learning was problematic. And so this debate became very noisy and is still very noisy. And indeed, you may think that that the efficient markets hypothesis is something that we can safely confine, or consign rather, to the history books. It's something that surely cannot be right. It's something that must be wrong. So in today's lecture, what I'll try and do in the time that's available is talk a little bit about the efficient markets hypothesis. We'll talk about some deviations from it, the idea of rationality related to fundamentals, but also the idea of beauty contests, where it's not fundamentals that matter, it's your views about other people's views, which we'll talk about briefly. It's a very famous example, one which I'm sure many of you have heard about. The problems of some kinds of markets in forecasting, and I'm going to take a little low and unpleasant shot at our competitors in the polling industry. I had great fun laughing at them as an economist, but I shouldn't really. How we might do better in prediction markets. How the theory of the efficient markets led itself to testing its efficiency. That, in a way, what made it so powerful. It It's actually one of the cleanest tests that we have in economic methodology and economic literature. Very few things ultimately can be tested. So we're going to see a lot of work in the next couple of weeks about the possible risks or impact of a Brexit or staying in the European Union. And because we can't run the experiment again, we can't really know what the impact would be of any choice that we make compared to the alternative had we done or made the alternate choice. We can't possibly know. So in a sense, it's a hypothetical counterfactual that we're taking an educated guess on. But in this area, we can see that it's actually quite possible to test some of these theories. And I have to say, for those of you who don't believe in the efficient markets hypothesis, it's phenomenally difficult to reject. You can try and try and try again, but you'll find it very hard to reject. Very hard. And that may be sad news for people here. That said, there are still a few anomalies, which I'll discuss, and we'll try to see if we can explain them in some way or other. And at the end, we'll have a look at one way of thinking about the way markets react or overreact, and I'll talk through a little event study. So that's the idea that we have a little bit of news that no one knew anything about. The market learns the bit of news at a discrete moment. We then gauge the impact of the market to that news and see whether it responded in a rational manner. And I'll talk about one, but there are thousands. And we'll see what we can learn from that. In the end, I'll make some comments about whether there is some ground between the two warring parties, somewhere that we could think of as a safe area. That's what I want to think about. So, the crisis, I think, the response to the crisis from a number of people who were opposed to the idea of efficient markets and rational expectations reminded me not a little of the outburst, for those of you who are old enough to remember, of this Norwegian commentator, Bøye Lilleland, when Norway finally beat England in a competitive match in 1981. I strongly urge all of you to go and listen to his commentary on YouTube when you get home tonight. It's a wonderful example of all the sense of a small country beating a larger country, but one in which they had great respect for. And this man spontaneously read out a list of famous English figures who had to pay attention now that Norway had finally beaten England at football. I don't think I'll try and do his accent, but the last line is extremely famous as he shouts, as the Norwegian English players leave the field, "Maggie Thatcher, can you hear me, Maggie Thatcher? Your boys took a hell of a beating. Your boys took a hell of a beating," he said. And the vehemence with which he said that reminded me not a little of those who were opposed to the efficient markets hypothesis. And a number of people have done this in the past, but I thought I could put in the names of all the economists who are associated with the efficient markets hypothesis, many of whom have got Nobel Prizes, in fact. And I could hear these kind of anti-efficient markets guys sort of saying something like Leonid Herfurth, John Muth, Paul Kagan, Robert Lucas, Thomas Sargent, Neil Wallace, Christopher Sims. We've beaten them all, because the financial crisis showed that the efficient markets hypothesis was wrong, they say. Eugene Farmer, can you hear me, Eugene Farmer? Your boys took a hell of a beating. Your boys took a hell of a beating. And that seemed to me where we were with the almost annoying debate that we had for several years after the financial crisis struck. And we had genuine hardship that we had to address with policy and think about the reform of financial markets in an important way. And so we be absolutely clear. The efficient markets hypothesis and those who criticize the efficient markets hypothesis, I think, are thinking about financial instability and have in mind perhaps other notions of efficiency than that which is suggested by the efficient markets hypothesis. This is, as we'll discover, an idea about the use of information. If I have an incentive to use information from which I can make money, I will use the information. That's really what the efficient markets hypothesis is about. It's not about making any statements about whether ultimately scarce capital has been properly allocated or not. Neither is it about the organization of financial markets. It doesn't say that they're always perfectly organized. Neither does it say that portfolios are able to minimize the variance of a return for an expected payoff, which is another form of portfolio efficiency out there. The efficient markets hypothesis doesn't assume any of these other ideas of efficiency. It's simply an idea about the use of information. And of course, these financial markets, which may not deliver efficiency in the ways I was just described there, may well be constrained or distorted by all kinds of incentives on bonuses or wages, rigidities in their operations, costs of their operation, regulation, or even policy-induced moral hazard, which is, again, nothing per se to do with the use of information in financial markets. And so there's a further problem that can sometimes emerge, and people start to say that if financial markets are efficient, why don't they always make correct predictions? Now, of course, it may lead to a very sad end for me if I were to criticise the Queen in public, so that's not what I'm trying to say here. But clearly, when the Queen visited the LSE in 2009, she asked the very sensible question, why has nobody noticed that the credit crunch was on its way? And of course, if we'd all noticed the credit crunch was on its way, we could expect a large change in asset prices, particularly of those that were vulnerable to the risks of a credit crunch. That's what we'd kind of expect, particularly those of financial institutions. So another way to think about Her Majesty's question is that if we had known that a financial crisis was on the way, surely there would have been an earlier downgrading of the prices of financial assets that itself might have led to a financial crisis. So the point then is that only at the point at which did we realise there was a financial crisis did the prices of assets adjust. And they adjusted immediately, which is exactly what the efficient markets hypothesis would suggest. When it becomes obvious we've entered that state, of course the prices will jump, which is what happened. So the lack of a clear forecast until we'd understood it was going to happen is exactly consistent with the efficient markets hypothesis. And so the question led to a response from the British Academy, written in this case by Tim Besley, Peter Hennessy, and they wrote in the letter to the Queen, many people did foresee the crisis. However, the exact form that it would take and the timing of its onset and ferocity were foreseen by nobody, they argued. What matters in such circumstances is not just to predict the nature of the problem, but also its timing. There is also finding the will to act and being sure that authorities have, as part of their powers, the right instruments to bring to bear on the problem. So there's a number of issues there about identification, the use of instruments and tools and timing, which means that even if you thought there was a crisis about to come, if you didn't have those instruments, those tools or those timings, you still may not be able to do anything until the point that it happens. That's their response. And in his defence of economics or macroeconomics, written a little bit later in September, this letter was written in July, this was written a little bit later in September, I think, Robert Lucas argues, in line with what I guess I've just argued, one thing we're not going to have now or ever is a set of models that forecast sudden falls in the value of financial assets, like the declines that followed the failure of Lehman Brothers in September. The main lesson we should take away from the efficient markets hypothesis for policymaking purposes is the futility of trying to deal with crises and recessions by finding central bankers and regulators who can identify and puncture bubbles. And this is the key point. If these people exist, we will not be able to afford them. If they already have that knowledge, they'll be positioned in such a way as when it does happen, they'll make tremendous amounts of money. So, let me recap. The efficiency that we're going to talk about is the incentive that agents have to trade any information they have privately so it becomes available publicly and affects the price of the asset. So the price of the asset now incorporates the private information that the trader has just imparted on the asset by acting in the trade. So it encourages the flow of information that you may have individually and you may not want to share with the world, with the rest of the world. Because you're saying, if I can share this information, the price will move in my direction. And if we all share the information, all private information translates its way into the public domain, and the price of the asset reflects all that information. And so when we think about the pricing of any asset, what we're interested in is its expected payoff. Now, some of you may look at the history of returns on an asset. You may sit down and do some calculations or get your assistant to do some calculations for you, and you'll say, well, that looks like a good asset. It's doing very well. The past returns ought to be no guide to the future, is what the efficient markets hypothesis tells you. The past returns may tell you about the risk for which the asset gave an excess return. So if the asset has a particular risk attached to it, and you want extra return for bearing that risk, you may be able to identify those risks in the asset. But other than that, the prospective or expected returns are going to be determined by the following things. Your expectation of the set of different states of nature, how likely are they? Let's break it down into 3 possible states of nature. Good, bad, or indifferent. And if you attach probabilities to those different states of nature, you would also want to understand what is the return in those different states of nature. If the probabilities of those states of nature add to 1, and the returns you've calculated, you can then work out the expected payoff from the asset. The prospective payoff is simply the probability of each state of nature multiplied by the return in that state of nature. And that is what you're calculating with the prospective return from an asset. Now, the observed market price therefore reflects the opportunity that you're foregoing by investing in that asset or saving compared to all other assets. And that opportunity cost is the rate of return that you want from holding that asset. And so, let's suppose you have 2 assets and you've been able to calculate the expected rate of return by multiplying the probabilities by the rate of return in each state, and they're the same. You get the same rate of return from the 2 assets, and they're the same price. If, on the other hand, you imagine that one asset is riskier than the other asset, you'll want to buy it for a lower price than the other asset. And that lower price you can see here is in the denominator, which means that you want an extra return for holding that riskier asset. So, what's the process? You collect information on the asset return in different states of nature. You come up with a belief as to the probability of those different states of nature, and then you derive an expected return from the asset. If you're risk neutral, which we've covered in earlier lectures, you don't want a premium for bearing risk. If, on the other hand, you're risk averse, you want a premium for bearing risk, and the price of the asset will fall somewhat relative to the risk neutral position. In this world, I'm pricing the asset in a rational manner. I'm working out rationally the expected return and foregoing a level of consumption today in order to buy that asset. All well and good. I'm coming up with a first order pricing idea for the asset. The alternative way, or an alternative way to think about asset pricing, is to forget all of that. I'm not going to sit down and make the calculation. It's far too expensive to hire a couple of master's students to do all that work for me. I'm going to try and guess what I think someone else thinks the price is worth. I'm going to enter in a beauty contest. What matters to me is not my expectation of the payoff, the first order or personal view. What matters to me is my expectation of others' expectations of the prices. So, the beauty contest analogy is obvious. What matters in terms of if you're going to bet on who's going to win a beauty contest, I don't know if we have them anymore, I don't remember seeing one from them. But if you're going to bet on who's going to win a beauty contest, what matters is not the person that you think is the most beautiful or wonderful, it's the person who you think the judges is the most beautiful or wonderful, and that's where you should put, or who you should put your money on. That's the beauty. So it's your expectations of other expectations. And once we get into that world, it should be easy to see intuitively how the price may diverge from the fundamental price that I've just outlined. If I think that others are particularly attracted to an asset at the moment because it's fashionable or it's in a fad stage, then I could sell it for more, or think I can sell it for more, and I'll try to raise the price. And as I raise the price, I lower the expected return below its rational level. But if some other person is prepared to pay for that, that's good enough support for me. But the fact someone else may be prepared to pay may reflect a large number of things out there in the economy to do with fads, fashions, liquidity, access to funds, movements in the cost of funding, or the ability to borrow from banks out there. So you may get a large number of non-fundamental factors affecting asset prices in that world if you believe in the beauty contest story. So if I've bought an asset with an expected set of payoffs, I've implicitly worked out a set of conditional forecasts. I've said conditional on a good state, I think the asset's going to give me this. Conditional on a bad state, I think the asset's going to give me this. Conditional on normal times, the asset's going to give me something else. And I've made an implicit set of forecasts. What then happens is one of the three states. And that means you're going to be wrong. And we'll come back to the nature in which we're wrong a little bit later. But everyone goes on to say, well, economic forecasts are bad, or financial forecasts are bad, because incorporated in this asset price were a set of different states of nature. When only one of them obtains, does that mean you were wrong? It's very hard to tell on one observation. You may well have had the correct probabilities of these different states of nature in your mind, but on one draw, one of them obtains with probability 1. But you didn't assign probability 1 to that state before it happened. It doesn't mean you were wrong, but it's often interpreted as though you were wrong. So let's think how we might be able to decant the correct probabilities. And the way I might want to do this is, for the moment, if I'm allowed, just take the high ground. Because there's one set of forecasters, or one group of people, who I would argue are at least as bad as the forecasts that economists have. And that's, I've already hinted, the pollsters, which tend to make economists feel rather good. And here we have, these lectures are in no way political, but I thought it was a wonderful picture of a Labour activist who'd clearly been expecting a hung parliament in the election last year, 2015, and as the results came in, the rest of his colleagues had gone home. Party never got started. He's looking wistfully at the results as they come in. You'll remember that prior to the last election, the media were getting very excited about the prospect of a hung parliament, because the polls, or the polls of polls, or the polls of polls of polls, or whatever it was going, I didn't really follow it all. So it's essentially that the common vote would be set up in such a way that Labour and Conservatives would be neck and neck at 34%. That would translate itself, even in our first past the post system across the seats and the complicated way that works, into some form of hung parliament, which would keep the media in forms of rapture for several weeks after the election, because it would give them things to talk about. Nothing's more hilarious than the media talking about things that don't matter. But anyway, of course, what happened at the election is that it was approximately 37% of the share for the Conservatives and 30% for Labour, which meant that David Cameron was able to become Prime Minister without the support of the Liberal Democrats, without a coalition. So we had a result that the pollsters hadn't anticipated, and neither had the media. The British Polling Council then set up an inquiry into the forecast failure, something which we economists are quite used to with all the post-mortems we've had since the economic crisis of 2007. So it was very nice to welcome them aboard. And I think, as far as I can see, they came to the basic conclusion that the reason their forecasts were wrong was that their polling sample didn't conform to the actual sample of voters in the country. So you can think about this as a problem whereby I didn't get the probabilities of different states of nature correctly, given the problem that I've just outlined. What I did was I wanted to sample the true, objective distribution of likely Conservative or Labour voters. But what I did from my polling techniques, I think they used mostly telephone techniques, so they caught the kind of people who were home in the afternoon, which probably doesn't catch everyone that they ought to catch, but anyway. So they got a biased sample. That's the kind of argument, I think, that they came up with. And it could be right. It could very well be right that the sample was wrong. And I think it's the argument that many economists use when we were criticised for not forecasting financial crisis. The same problem. If my model has used 15 years of non-inflationary growth to forecast the future, it's pretty unlikely that model is going to pick up a massive financial crisis. So one of the ways that economic forecast or economic thinking has had to move after the crisis is to use much longer samples and think more about when crises are going to emerge. Actually, there are other possibilities, and one of them comes out the economist toolkit of people using information efficiently. I'll just take a sip of water. And it goes in the following way. People may simply have changed their minds given the information that was in front of them. If the polls predicted a hung parliament, and that would result in an extended period of uncertainty, people may have switched to their second best choice in order to avoid such an outcome. And you only need a small number of marginal voters, in this case 3%, to switch, to explain the difference between the outcome and the expectation. And this is an example that economists are familiar with because it's an example of the Lucas critique. And that is the following. If I can see the policy and welfare consequences of a given choice or plan, and I don't like it, I can reformulate my plan so it yields a better outcome for me. And there's a world in which we might have done something like that. I think it's the sort of thing that also went on in 1992. So my only warning would be, let's be wary of all the opinion polls that we see and read about in the run-up to the referendum next month. We're quite smart, I think, and we might optimise and re-optimise and think again about both the signals that we want to tell pollsters and how we might use the polling information when we finally go into those booths next month. Now, how can we cut through the problems of sampling and changes in behaviour so that people do what they say they're going to do? Well, I think it helps to have money on the outcome. I think it helps if you've put your hand in your pocket and taken out some of your post-tax income and decided to bet on what you think is going to happen, or that when you say you're going to do something, it has consequences for your finances. Consider the following story. There's two horses, one called Red and one called Blue. I might phone a bunch of people to get a view on which horse is going to win. But the people who know all about Red are at work, so the only people I manage to get on the phone are those who like Blue. So I'm the bookie. Everyone I phone says Blue's going to win, so I just install Blue as the nap, the favourite. Blue's going to win. As everyone I've rung has told me Blue's going to be the favourite. But Red is actually a very good horse. I just haven't managed to sample or talk to anyone who knows it's a very good horse. And those who know but haven't been part of the polling sample, in fact, if you think about it, they've got an incentive not to be part of the polling sample, and for the following reason. The odds on Blue winning as a favourite will also imply, in a two-horse race, providing no horse falls over, that the odds will be against Red winning in the same way, in exactly the opposite way. So if I haven't shared my view Red is a very good horse, I'll get very good odds on Red when I go to the bookie. And in fact, I'll keep putting money on Red with the bookie, because I'll get much better odds than the true probability of Red winning, because the bookie has got biased odds because he hasn't or she hasn't sampled the population of gamblers properly. And indeed, if I open up the betting market so that those who know about Red can translate their views into a bet on Red, the odds against Red will fall, and eventually it will become the favourite. The odds will reflect the true probability of Red likely to win. If I didn't open up the market, I'd never discover that. I'd think that Blue was going to win. And that's how, in some sense, very simply and very intuitively, we might be able to use markets to get a better idea of who's going to win things like elections or any kind of uncertain outcome. Now, I hope this next chart is reasonably visible. It's not terribly clear, for which I apologise, but I'll spend a second explaining it to you. In fact, in the United States, in Iowa, there are Iowa prediction markets at the University of Iowa. And what they do is allow people to bet in exactly the same way. If you can see the y-axis on the left-hand side ranges essentially between 0 and 90. It's the probability. Blue represents Obama and Red represents Romney. And this betting market starts from the middle of 2011 and ends with the election at the end of 2012. And because there's a betting market, the probabilities add to 1, and people are betting essentially on whether Obama or Romney was going to be installed in the White House after the election in November 2012. Now, I don't follow American politics particularly closely, but I do know that on a number of occasions people weren't sure who was going to win through the polling. And in fact, I've taken a slice of the polling in the September, October, November, the 3 months leading up to the election on the right-hand side. And this is a poll of polls, or whatever they say it is. The red line and the blue line are the averages of the polls taken at any particular time. And what you can see is if you were taking the polls alone, and these are the guys at the end of the phone, these aren't the guys that necessarily represent the full population of people, it looks very close. Certainly, in the month before the election, it becomes too close to call. It suits the media because people can have a lot to talk about. We don't know who's going to win. But for those of us who were following the prediction markets in which people were placing real money, we were not worried. It was very clear to us that Obama was going to win. Have a look at the markets for Clinton versus Mr. T when you get home. See what you think. I decided not to put that up. I didn't want to influence things. So I think once we introduce money and financial returns into the equation, people have an incentive to form, I think, rational, near-rational views. Let's take a second to look at some financial data. This is the US euro daily exchange rate, 1998 to 2014, and the bars in the middle correspond to recessions, and the series is what economists call a random walk, and I'll explain that in a minute. But essentially, the idea of the random walk is that in every moment, all of those who have a view on the exchange rate of whether it's going to appreciate or depreciate, would trade that view into the observed exchange rate, so that there's no further information that would affect the exchange rate out there in the marketplace. Nothing else you could say at any moment in time would influence that exchange rate because it contains all the information that's available. But what people do, and this random walk means that if all the information that is out there is contained in today's price, the only thing that can affect the price tomorrow is tomorrow's information. And tomorrow's information, by definition, is not known today. Otherwise, it wouldn't be called tomorrow's information. It would be called today's information. And this then means that tomorrow's change in price cannot be forecast. It's orthogonal. It's unrelated to the information that we have today. So what we can see, what we'll actually observe, is that these day-to-day changes are bits of news. We could call them bits of noise. We could call them whatever we want. But they're things that we cannot forecast today that come along tomorrow to move the exchange rate. And so they're random. The movements are random because they reflect noise. But you can wander into the city. You may go to a meeting. Better not mention any firms' names. And people may tell you there's a trend in the data. They may say the trend is your friend. The exchange rate's moving up. Look, you can see a pattern there. You can see heads and shoulders. You can see, I don't know what the hell people talk about. You can see anything that you want. And as a result of what I can see, I can tell you where the exchange rate's going to go next. That doesn't fit in with the efficient markets hypothesis in the way that I'm trying to tell you, and is not a good way to plan your investments. If what you see is that this is a random process. But if you look hard enough at it, just as you might, as a child when you were lying on the grass looking at the sky, see patterns in the clouds, and imagine that maybe a dragon was fighting a stegosaurus or whatever else it was it might be. It wasn't actually happening. These were just water droplets, right? And in the same way here, the movements in these asset prices are random and not predictable or forecastable. Now, you may not quite be able to see, but here I'm just showing another example of financial prices, and that is returns, annualized returns of the FT 100 at monthly and annualized frequency. So we take the monthly return and annualize it, or the annual return And you can see that the blue line, or you may be able to see, or maybe just to be able to see, the blue line is like a long-run moving average of the red line, which is what you'd expect, and the volatility is much, much less. So a lot of the things to do with noise seem to dissipate over time. We get offsetting movements. Bits of news come along, we go in one direction. The next day, another bit of news comes along, we go in the other direction. Over time, these cancel each other out, so the noise disappears. And what we see at lower frequencies is that volatility seems to go away, and longer time compresses volatility. So we move on. If all of this is right, where does it come from? Where can we think about the idea of random walks? Where do they come from? Well, let's start with the simplest idea, which is what we might call a martingale. And a martingale is simply a fair game. And what we mean by fair game is that it's not history dependent. And the obvious example here would here be a coin toss. At every moment in time, we know that there's a 50% probability that a fair coin will come up heads or tails. We can describe the process, but we don't know on the next coin toss whether it will be a head or a tail. We can't possibly know that. And the other point to make is just because in the previous toss we had a head, it doesn't mean we'll have a tail next time. So even though the probability is 50-50, we don't know over very short samples exactly what the proportion might be. It might be a very wide variance at all. So we get the idea that we can predict the process and understand the process that's generating asset prices, but we can't necessarily predict where asset prices would come. And let's reformulate that idea with some simple symbolic maths. E here is expectations. PT plus 1 is the price level tomorrow, PT plus 1. And omega represents the set of available information at time t. So it says that my expectation of an asset price tomorrow is going to be conditioned on whatever information set I have available to myself today, and that will then determine the price level today. Now, if it was anything else, let's suppose, just for a minute, that my expectation of the price level tomorrow, that's the EP T plus 1, was greater than the price today. What would you do? What would you do with the asset? If my expectation of the price tomorrow was greater than the price today, I'd buy the asset, exactly. So there'd be if that didn't hold, there'd be an obvious arbitrage opportunity. I'd just buy the asset because EPT plus 1 conditioned on omega t minus PT is greater than naught. I'd just buy today until it equaled naught. I'd eliminate the arbitrage opportunity. Similarly, if it was less than PT, I'd sell PT so the arbitrage opportunity disappeared. Now, we can't very easily know all the information that anyone may know at any moment in time. But we do know that omega PT must include all the lags of the asset prices that we can observe. So even if I don't know all the bits of information that the city may know about a particular asset price, I can observe the price. And I'll assume that the information in the past made its way into the price that we can observe. So I don't have to condition on information. I can just condition on the price. What that means, therefore, as we think about it, CoV here just means covariance or correlation. It just means the relationship between two assets. RT plus 1 is the change in the price, so PT plus 1 minus PT. And omega t is the information set. And if the information that is available today has already made its way into today's price, tomorrow's price, actual price, PT plus 1, cannot be correlated with the information that I have today if it's already in today's price. Now, as I've said, I don't know all the information that might be available. So what I can do is substitute back in today's return for the information set and assume that today's information set, omega t, is related to today's return, RT. And so I get this testable prediction that if all the information that is available that's relevant for a particular asset price has been traded into the price, today's price has adjusted to reflect that information. That then means that tomorrow's price is only affected by information I haven't received. Therefore, the correlation or covariation in this case between returns tomorrow and returns today must be zero, because the thing that's driving the difference are bits of information we don't yet know. And this will hold at lags and leads. This is the covariation between the first expression of the covariation between tomorrow's return and today's return. The second expression is the covariation between today's return and yesterday's return. It would hold at every moment in time. And it's this manifestation of the efficiency of information usage when we have an incentive to use it that allows us to test the efficient markets hypothesis, and so many people have for 40 years or so. Now, there is some mild evidence that the estimated covariation or autocorrelation is non-zero, some small numbers suggesting that on a day-to-day basis, if there's been a positive return today, there may be a positive return tomorrow. And some longer run evidence suggests that if there's been 4 or 5 years of boom, which would suggest positive returns, there'll be 4 or 5 years of bust that would mean negative returns, so the average return would stay the same. Some mild evidence. I wouldn't say it's particularly convincing, but I'm trying to be fair. I've already told you what I think about technical analysis. I think the key point with any of the small variations that people have seen, where it's been possible to reject the zero covariance result, is that the tests have mostly been conducted in small samples, which may be unreliable, and that the correlations that have been found may not have been large enough to make much money from. So I would cast doubt on people who tell you that they find lots of information from previous asset prices for future asset prices. The model predictions are that the covariation between returns is zero. What people do is collect the evidence and then test the hypothesis of whether the covariation is zero. And this allows people to use a scientific method. And the question we want to ask ourselves is whether one rejection is sufficient to reject the theory, or may there be particular circumstances that led to a regression. That's something for people here to think about. But if we take the position that the markets are essentially informationally efficient, we can draw the same conclusion that William Sharpe did, that a market is efficient with respect to a particular set of information if it is impossible to make abnormal profits other than by chance by using this set of information to formulate buying and selling decisions. And this led to a number of statements to do with the weak form, semi-strong and strong form efficiency. The weak form simply says that the information set is current and past prices. They're the kinds of tests I've just described. The semi-strong concerns itself with all publicly available information, meaning that prices move when private information becomes public. And there's a strong form efficiency where all information, whether it's public or private, is already incorporated in the bond price. Now, before going on, I should spend a minute just explaining an idea after Grossman and Stiglitz that says that this cannot be the case. And their argument is the following. They argue that information is actually costly to obtain, and prices reflect information. If information is costly to obtain and prices reflect information, the argument then would be who would incur the cost of collecting that information? If no one wants to spend any time collecting the cost of information, asset prices then cannot reflect all information, and thus asymmetric information matters. And that's the Grossman-Stiglitz paradox, easily seen really with some symbols again. And the symbols are saying, well, under a strong form of information efficiency, the expected return on asset I is going to be given by mu, that's the Greek letter at the end there, and that gives me a return on the asset. But let's suppose in order to get that return on an asset, I have to pay a cost to collect the information. Let's call this cost CI. Now, if the markets already have the cost, who would want to pay the cost CI? The markets can already get this return. Why are they going to get the cost? But if the cost is not paid, how will the market get the information? So the circularity that Grossman and Stiglitz point to. The market has the information, no one's going to pay it. But if the market doesn't have the information, how will the markets get the information? And that's the puzzle that they pose. And if we believe in that, then we know that markets will be affected by changes in costs and changes in anything that regulates the flow of information in the marketplace. Now, there are a number of small asset market anomalies to do with either calendar day effects, weather, sports results, which seem to lead to all kinds of anomalies in some places, small firm effects, high price-earning ratios or initial public offerings. And just a moment's thought will tell you why these are anomalies. Let's suppose there's a Tuesday effect. The stock markets always do badly on a Tuesday. If you know they'll do badly on a Tuesday, why doesn't that effect disappear? Because if you know that the market will fall on a Tuesday, why wait till a Tuesday? I'll sell on a Monday. If we all know that we're going to sell on a Monday, why wait till Monday, sell on a Friday? And then what's going to happen is this anomaly should dissipate through time like so much water in a river. And these anomalies, it's not clear that they all allow genuine profit opportunities. Many of them just seem to, again, capture excess risk. For example, small firms may offer more risk than large firms or well-diversified firms, and the extra return may reflect that. One area where I've tried to understand anomalies is the question of whether bond prices, which should reflect long-term trends as well as short-term news, tend to overreact to day-to-day news. To remind you, a bond price collects a series of short-term interest rate expectations over the life of a bond. And even though shocks may come along to perturb the expected path of short rates, we can measure the rate of decay of the shock and hence the expected impact on short rates and thus on long-term bond prices. And we regularly find that long-term bond prices display excess volatility. In some senses, this finding harks back to the work of Robert Shiller, who found that equity prices displayed excess volatility compared to actual future profits. One answer to the Shiller problem is that the outcome is one of many possibilities across many states of nature, and any news today may affect all those probabilities, leading to heavyweight price volatility. And actually, there are a number of answers to the bond price anomaly. Long-term bond prices, which reflect some notion of steady state, may get dislocated by shocks in the absence of a nominal anchor. Risk or term premium may dominate movements in these prices, or our ability to construct alternate futures is bounded. So we overweigh the present or the recent past. When we really think about the future, we don't actually think about the future. It's just too hard a problem. Indeed, I tend to find that the more volatile bond prices can be generated if agents themselves adapt very slowly to economic shocks, which implies a perverse result that a stickier real economy may create more volatile prices, on which more later. Other areas that seem to violate rational expectations involve herding. And here I want you to just imagine how a herding phenomenon might occur. We've entered a town. We don't know anything about the town. And our smartphone has a charge which is flat. So I'm unable to find out anything. And I find myself standing outside a restaurant, and I don't know which one to go in. I have no information. The fundamental story is that both restaurants are equally good, but I have no information to tell me. So I randomly decide to go into the restaurant on the left. A few minutes later, another person comes along, and she has no information about the restaurant. Her smartphone is also lacking any charge, and she has to decide which of the two restaurants to enter. There is now an observable difference between the two restaurants. I'm sitting in the one on the left with a glass of wine in my hand. And she thinks, well, that must be a better restaurant. So she enters the restaurant. And very soon, in the restaurant on the left, there's a party like it's 1999 going on, as everyone enters the restaurant on the left. And we have there an information cascade. It's the kind of cascade we can see in asset prices and financial markets when there is an inability to collect full information about the fundamentals. And actually, the cascade, if I was a rational markets guy, I could say, could be still yet be broken. If the restaurant on the right could lower its prices in the course of the evening, and that might be just enough to attract someone in who would then send a different kind of signal to people outside, and that may be sufficient to break the information cascade. So again, we have a world in which prices, or asset prices, may adjust and provide an incentive for you to take a gamble, or an incentive to you to try the other restaurant that would then promote learning about the quality of the restaurant on the right. Now, another problem is, as well as herding, which may mean we don't have full information about asset prices, that it could be that even the analysts themselves, who we pay to find out about firms, don't give us a full range of possibilities. And a simple example here will suffice. Consider what we have here is the sum of the roll of two dice. And because this is they're two fair dice, we'll know immediately there are 36 possible combinations of numbers that can come up with 11 possible outcomes, 2 through to 12. Won't have to explain that to a Gresham audience. You would have known that immediately. Each of these possibilities, 2 to 12, have their own specific probability, which I've put on the y-axis here. So if I ask 36 people corresponding to the 36 different probabilities, which is the outcome that we'll obtain when I throw these two dice, you're all going to give me the modal forecast of 7. The probability of 7 is about 16%. But 100% of you will say 7, because it's the most likely outcome. Therefore, the sample of the analysts are giving the central outcome and not allowing us to portray the full distribution of possibilities. This may then mean that we're collecting forecasts and ideas that tend to the mode and tend to look very much like each other, because we're not asking people for the full distribution of outcomes. This then means, for either herding reasons or informational herding reasons, that when bits of information do come along, they lead to large surprises and large movements, because we haven't fully absorbed the true set of probabilities out there. Everyone has been telling us what's going to be most likely to happen without us considering a wide range of possibilities. And so we can see in event studies, when events come along, there can often be very large responses because they reveal an outcome that wasn't fully priced in by either the actual herding or the informational herding that may go on in marketplaces. With the handout, there's a bit more detail, but we can see, for example, in May 1997, the unanticipated announcement of central bank independence led to a fall of some 50 basis points in the yield curve, almost exactly 19 years ago. 2nd of May, with a bank holiday, the announcement on the 6th of May, jumped down the yield curve of 50 basis points, which is reducing, to this day, the cost of funding government debt by £50 million for every billion borrowed. That's what a 50 basis point cut does. That's the news that should have been anticipated, but wasn't. The response tells you that the market was able to rationally absorb the information that came out from this change in monetary policy. So Despite the anomalies I've outlined, I would argue that the efficient market hypothesis is still the key to finance. Asymmetric information is out there, but it's not centre stage. And even though there is some mild evidence of zero correlation returns, I think most of those excess returns are related to risk sparing or some anomalies in market practice. Event studies show that markets are surprised in predictable ways, but often respond in an excessive manner because information perhaps isn't shared fully in the way that it might be. We might want to think about ways of getting more information out there. I know many analysts' work in the city is not distributed widely. It's very hard to get hold of. There may be areas in which we could disseminate more information than we just find in the Financial Times. I think the remaining anomalies we may be able to observe are likely to be related to learning about complicated matters, the operation of policy, and varying degrees of liquidity that we may find in financial markets. I think modelling the interaction of many states, many views, the drip-by-drip nature of news, and as well this continuing problem of the interaction of traders with policymakers will eventually help us further understand market pricing anomalies and maintain the efficient markets hypothesis in terms of its use of information is here to stay. Thank you very much.